Okay ladies, this module is all about super. Now before we even get started, I wanted to have a chat about what super is and what super isn't. A lot of the time when I ask people why they think super is good, they tell me it's because it's a good investment or it goes up over time. It's actually not super that's an investment or super that's going up. Super is just a vehicle for your investments. You could hold cash or term deposits or Australian shares or international equities through your own name or through a family trust or a company, or you could own these assets through super. And just because it's in super doesn't mean it's always going to go up. Think about it as vehicles on a highway. You could be in the fastest sports car there is, but if there's an accident up ahead and traffic's at a complete standstill, then being in a sports car doesn't help you. You're still in a standstill like everybody else. On top of that, we know there's different types of sports cars. They have different features that might be important to you if you're the kind of person that likes sports cars. Some will be fuel efficient and cost effective. Others will come with more options, and if you know how to drive them properly, would then let you win a race against another sports car. Super's kind of the same. It's just a sports car for your investments. It's just that it's a very efficient vehicle to hold your portfolio and your investments in because of its tax rates. In super, the tax rates are between 0 and 15%. We'll go into different tax rates and super accounts in the next video, but for now, it's probably enough to say that it's better than any tax rate you're going to get as an individual once you're over the tax-free threshold. And that's the biggest benefit with super. That, and you can't access it, so you have to save it. The other benefit, although not everyone agrees, like I say, is that it is that forced way to save. You can't access your super unless you meet certain rules called conditions of release. Again, we'll go into those in a bit more detail in another video, but it is a great way to put money away for your retirement. One of the other benefits is that some super contributions, or the way that you put money into super, which is called a concessional contribution, is tax deductible when you make those. So it can be another good way to save for your future in a very tax effective way. It's worth saying though that like everything with money, with every benefit comes some kind of negative or downside. When you put money into super and claim a tax deduction for that, then the super fund itself is then going to pay a contributions tax at 15%. It's worthwhile doing some numbers before you start making super contributions to get tax deductions, because if you were under the tax-free threshold, the idea of putting in super and getting tax deductions for it would actually end up costing you money. Anyway, back to sports cars. I mentioned that there were different types of sports cars with different options depending on what's most important to you. Well, there's different types of super funds too. There's industry super funds, like the ads you see on TV. They're widely used for super guarantee contributions, the ones that are made by employers when you get paid. They're usually lower to medium costs, but they also have limited numbers of investment options and hold larger positions in unlisted assets like property, private equity, and infrastructure. They're a not-for-profit fund, so any profits are put back into the super fund itself. Then there's public sector funds, so they're super funds for government employees. Many government employees pay more than the minimum 9.5% super contributions. They're usually quite low in fees as well and have a modest range of investment choices. Like an industry super fund, they're also a not-for-profit fund. Retail super funds are usually run by banks or investment companies. Some of these would include Sun Super, Colonial, MLC, BT or Macquarie. They range widely in fees. Lots of them actually have a low-cost option with less choices, and then a higher cost option with a huge range of choices. Then there's a self-managed super fund, or SMSF. These can have up to 4 members who are friends or family. Most self-managed super funds have 2 or more members, and as a member, you're also the trustee of your fund. Or you can get a corporate trustee, in which case you'd be the director of a company that's a trustee of your fund. In either case, you're responsible for the fund. You choose the investments and any insurance that you hold in the fund. There's definitely benefits and negatives that you should be aware of if you're going to set up a self-managed super fund. On the downside, you're actually personally liable for all the fund's decisions, even if you get help from a professional or if another member made the decision. You're responsible for managing the fund, even if your circumstances change. For example, if you lose your job. There might be a negative impact on your self-managed super fund if there's a relationship breakdown between members, or if a member dies or becomes ill. They certainly take a lot more time than any other super fund type. On the other hand, though, they offer control and investment options that wouldn't be available through any other type of super. I mentioned insurance there as well, and so I'm going to digress a little bit. Ladies, we talked earlier about risk, and you wrote down what risks concern you the most at the moment. One of the biggest risks to people's retirement plans that they often don't think of is actually their children. Now, with recent changes to super and insurance, we saw a lot of insurance covers get cancelled, so a lot more people don't have cover. And there's a few different types of insurance to be aware of. So the first one is death or life insurance. Now this one's pretty black and white. If you die, your family gets a lump sum payment, which can be used to help pay off their mortgages or provide for the fact that an income is going to completely disappear from a household. It's often held in a superannuation fund. It's important to know, though, that this also then means that the insurance will usually get paid to the super fund. And so there can be potential tax implications, as well as some estate planning issues that you have to think about. Then there's TPD, or Total Permanent Disability Insurance, which provides you with a lump sum payment that should be used to be able to cover medical treatments or provide financial security because you can't work. Now, it's important though to know that there are two types of TPD. There's an any occupation and there is an own occupation. It's important to know that if you just have TPD in your super fund, you'll have an any occupation rating, which means that it's based on your previous education, skills, training and experience. Your own occupation means that it covers you if you can't work in your own occupation, which is probably very important if you have some kind of specialised job. So you'll know if you've got own occupation because usually this means that you're paying for part of it yourself because you can't own all of own occupation in a super fund. The only type that you can have in a super fund is this any occupation. The next type of insurance is called trauma insurance. So trauma insurance sometimes gets called recovery insurance, and it's an amount that's designed to provide a smaller lump sum to provide for things in the shorter term. Things like increased medical costs or costs of home modification or reduced work hours while you're having treatment. If you think about it, this is one of the most important types of cover. So let's say you get breast cancer, which unfortunately is something that 1 in every 8 women get. The out-of-pocket expenses when you get breast cancer range anywhere from $1,500 to $17,000, rising with increased disease severity and your age. Usually, the number of hours that you work per week or the number of hours that's gained from a household while you're being treated decreases by half. Now, you probably wouldn't meet the definition of permanently disabled. You're not going to get a TPD claim. Your partner certainly wouldn't get any insurance because they're not sick. But your income will go down, your expenses will go up, and your partner might actually want to take some time off work to support you through your treatment. That's where you want trauma insurance. And the last type that I'll bring up is income protection, or IP. There's lots of changes happening in IP at the moment, but essentially the big thing to know is that this actually provides you with an ongoing monthly payment if you're unable to work because you're sick. It's one of the easiest ones to claim. It gives you an alternate source of income if you can't work because you've got an illness or an injury. Now, depending on your cover, it means that you're going to get a nominated monthly payment, which is usually 75% of your income, for a period of time so that you can keep your household up and running, paying for expenses that are going to keep on coming in even if you can't work. And usually they'll have a waiting period, so a 30-day, 60-day or 90-day waiting period. And then they'll have a benefit period as well. So they'll pay it for 2 years up to the age of 65 or whatever it has in your insurance contract. So it's important to have a look at this one. In reality, most people should have a mixture of some or all of these, but how much you need is going to be different for everyone. Back to super though, I started talking about insurance because a lot of people assume that they're covered by insurance in super, and it's just often not the case. It might have been cancelled because of a low super balance, or maybe you've moved your super and inadvertently cancelled your insurance when you've done that. So you also wouldn't want to have all of these types of insurance in super. In actual fact, you can't have all of these inside of super. Trauma and income protection will be outside super. And like I say, your kids are one of your biggest risks to your retirement plans. So what I want you to do is have a look at your insurance, but have a conversation with the kids and make sure that they don't see you as their insurance option if something goes wrong. Remember, it's like the airline. If something happens, you've got to be able to look after yourself first before you fit an oxygen mask to somebody else. So that's your homework for this module, is go and check what insurance you have and have that conversation if you have kids about what insurance they have as well, so that if something happens to them, their financial security doesn't come back on you.